I'm Troy Classy, mortgage lender. Today, we're going to calculate what type of loan amount or what size loan amount you may qualify for based on your monthly income. So there's several few steps that are very straightforward. So first, we're going to determine your monthly income. Salary W-2, it's pretty straightforward. Self-employed, there's a little bit of calculating to take first, but let's just take an income, and then what we're going to do is we can multiply it or use about 50% of that. That's generally safe if you have good credit for Fannie and Freddie and FHA's right in there, maybe a little more. So what we're going to do is once we have that number by 50%, this is your gross income, by the way, by 50%, then we're going to subtract monthly obligations, installment loans, or revolving minimums that you have to pay every month, whether it's a minimum of a credit card, an auto loan, we're going to subtract those. Now, the number that we have left is what you can use towards housing. And that's going to be, you're going to subtract monthly property taxes, your homeowner's insurance. If you have mortgage insurance, you're going to subtract that. Now you have a number left, and that's the number that you're going to plug into a calculator, like a financial calculator with the current market rate, and that's going to give you the mortgage amount. So let's try this. All right, so in this example, we've got a $10,000 monthly income right here. Plug your number in right there, multiply it by 50% or 0.5. That's going to leave you with half, or $5,000 in this case. Now we're going to subtract minimum monthly credit card obligation, not the total balance. So we've got a credit card here of $50. We've got a second credit card here with a minimum payment of $50. We've got an auto payment, installment loan here of $300, and then we've got a miscellaneous, debt installment loan, whatever it might be. Plug your number in right here. Subtract those from your 50% number or from your 5,000. That's going to leave you with $4,500. Now, this $4,500 is what you can use towards your housing. So we're going to start by subtracting taxes and insurance and mortgage insurance. All right, let's take our remaining income down here, 4,500. We're going to move it up here, and now we're going to subtract our housing expense. So we have monthly property tax. You can look up most homes, and they're going to give you an annual tax. Just divide it by 12. Hazard insurance, you can, I just take a little percentage or of the value of the home, or your best case is to call your agent. They can give you some sort of estimate, because there's different factors in there, right? Your deductible, the replacement cost, other things. Okay, next we've got mortgage insurance. Now, if you put 20% down, you don't have mortgage insurance. In some cases, you can put 10% down and not have mortgage insurance, but typically, if you don't put 20% down, you're going to have mortgage insurance. Now, this number is going to vary. Okay, that's going to be based on several factors. It's a risk calculation for the lender. Okay, your credit score comes into play. How much down payment or your loan to value is going to alter that a little bit, and of course your ultimate loan amount is going to change that a little bit. So good credit, for the numbers we're talking, we have about $100 in mortgage insurance. With 10% down. Again, varies, 5%, 15%, it's going to be more, 15% is going to be less, okay, because less of a risk, etc. And then that leaves us with 3,950. Now, this is the number we're after. This is the number that we can now plug into a financial calculator, or in some cases, you can hop online, find some sort of tool that will, take the present value at a certain interest rate. Okay, there's another one is that I have an app, a free app that anyone can download. I'll put that. I'll see if I can put the app link down in the comments somewhere, where you can just download the app on your phone and you can mess around with those numbers there. All right, if we take a 30-year loan, which is 360 payments at a rate of 7%, and again, the interest rate, that's going to, of course, that can fluctuate daily, weekly, okay? And we plug that in, that is going to give us a loan amount of $593,415. And just a side note, I've got with the 7%, it spit out about an annual percent rate APR of 7.25. But for the math, what we're plugging in is the 7%. Okay. So plug in your own numbers right here, give you a rough idea, rough estimate of the loan balance that you're looking for, that you're looking at. Have a great day.